how profit appears.
The stock market is a place where buyers and sellers meet. The products being traded are securities, for example, stocks. A stock is a share of a business. You can become a co-owner of Apple, Coca-Cola, or Tesla. It sounds grand, but that's exactly what it is. For you to buy a stock, there must be someone on the other end of the internet willing to sell it to you. Many people think they are buying stocks directly from the company, but that's not true. A company sells its shares only once during its first public offering, called an IPO. All other transactions, meaning the vast majority, take place on the secondary market. The money you earn comes from another investor. This is important. It does not come from the market, not from the government, and not from the company. It comes from someone just like you. And this raises a question. Why does another investor want to sell a stock at the exact moment you want to buy it? Both of you want to make money, yet you're doing the opposite things. One buys, the other sells. If an investor is confident the stock will rise soon, they won't sell it to you, but they are selling, which means either you are wrong or they are. One of you thinks smarter, one of you is making a mistake. Since we're buying and selling from each other, if you connect the chain of all transactions between participants, the market simply moves money from the pockets of some investors to the pockets of others.
The stock market is a device for transferring money from the impatient to the patient. Warren Buffett.
Does this mean the stock market is flawed and the only way to earn money is to outsmart other investors and take their money? No, it doesn't work like that. To understand why, we need to look at the two types of profit that exist. The first type of profit.
Investment income.
Imagine that you and a friend open a small grocery store. Each of you puts in $100,000. You could say your business has two owners. The store is in a great high-traffic location near the subway, and there are no competitors around. Business takes off. Things go so well that you manage to open a second store, and your income doubles. Now you own half of not one, but two stores. Then your friend offers to buy out your share, your stock. He wants to become the sole owner. In this case, you would ask for twice as much as you originally invested, because now there are two stores and the profits have grown. The deal happens. Your friend ends up with two stores worth $400,000, while you walk away with $200,000 in cash. Let's look at who invested what and who earned what. Each of you earned $100,000, and neither of you lost money or became poorer. But how is it possible that more money appeared? Where did the extra $200,000 come from if only two investors were involved and both ended up winning? Don't worry, here's the explanation. The culprit is the business itself. You and your friend didn't trade beads, you traded an asset that lived its own life. Inside that business, money was being created. People were buying groceries, profits were accumulating, and the company's value increased. The business expanded to two stores, and that's where the higher final valuation came from. For you as an investor, this was investment income. Investment income is when you earn money because the value of an asset grows, not because someone else put more money in. In a business, people work, produce goods and services. Your profit is the result of their labor. Earning investment income is not more complicated than putting money in a bank. You just need to buy shares of a company that will grow and wait for it to expand. As it becomes more valuable, the stock price rises too. As long as the company grows, every investor holding its shares can make money without taking money from each other. The downside is that businesses grow slowly. And the bigger a company becomes, the harder it is to grow further. Industry giants like Coca-Cola or McDonald's grow around 10% per year, year after year. To double your investment in such companies, you might have to wait decades, and sometimes the doubling may never happen. But 10% a year is nothing like the promises we hear online. So where do numbers like 100, 200% per year, or even per month come from on the stock market? Now it's time to talk about speculators. If you want to see the continuation, support the video, leave a comment, hit like or even dislike if you disagree, and subscribe to the channel